Welcome to our channel on accounting lessons with worked out problems, brought to you by an experienced accounting professor with a CPA. We have videos on all topics of introductory financial accounting. Our focus is on step-by-step illustration of a problem, worked out on a whiteboard. Please do not forget to subscribe. This video lesson is about accounting related to preparing cash flow statements, and it consists of 3 parts. The first part of the video lesson explains and illustrates the 3 sections of the cash flow statement and its format. The second part of the video lesson illustrates the indirect method of preparing the cash flow statement. The third part of the video lesson illustrates the direct method of preparing the cash flow statement. Let us go into the video lesson illustrating the direct method. The problem we are going to illustrate is listed here. Please review it before we start the illustration. It will be useful to have a printout of this problem to review while we illustrate it.
Now we are using the same set of information to prepare the statement of cash flows, operating section under the direct method. So here, the synthesis operation, we have to calculate the cash received for every income statement line item, that is the cash received from any sales revenue or service revenue, and cash paid for any expenses. Now since this is a direct method, we are only calculating the cash collection and cash payments. Therefore, the non-cash expenses are irrelevant, not relevant in this method. So first, the cash collection. So here you have to compare the accounts receivable beginning balance and the ending balance and the sales revenue. So that should give you how much they collected from the customers or collected from the sales. So first is collection from sales. So if you look at your accounts receivable, so this is much better if you use the T account because it's easy to calculate the numbers. So accounts receivable, the beginning balance was $80,000. And during the year, if you look at your income statement, the sales revenue was $660,000. So when the company made the sales, they would have debited the accounts receivable for $660,000. End of the period, your accounts receivable balance was $120,000. So again, $80,000 they started, they added another $660,000 to the receivable, and end of the year the balance was $120,000. So the receivable increased from $80,000 to $120,000, so it increased by $40,000. So what it means is, out of this $660,000 sales, they did not collect $40,000. So therefore, out of the total receivables, they collected how much? If you do the calculation, they would have collected $620,000. Okay, so you take this number. So collection from sales, $620,000. Okay, so this is the only item the company is going to have the collection. And then you have to look at how much they paid for the inventory, and how much they paid for, this is the payment for the inventory expense, or the inventory purchase. So first of all, I'm going to go do here. So here, payment for inventory purchases. So here, this is a 2-step calculation. First, you have to calculate how much inventory they purchased. So first, you go to your inventory account. As you said, the beginning balance was $36,000 and the ending balance was $44,000. So here, They started the year with 36,000. They ended the year with 44,000 in the inventory. And if you look at your income statement, it says the cost of the goods sold expense was 308,000. So out of the inventory, they took out $308,000. Therefore, how much they should have purchased? So they still inventory increased by $8,000 after selling $318,000 of inventory, which is shown in your cost of goods sold. Therefore, they should have purchased the inventory for $316,000. This is the inventory purchase. Okay. Now, how much they paid? That you have to go to the accounts payable. So when they purchased this inventory purchase for $316,000, they would have credited $316,000 in the accounts payable. Now we calculate how much they paid for the inventory purchases by analyzing this accounts payable. If you look at your balance sheet, beginning of the year, your accounts payable for inventory purchase was $41,000. This is the beginning balance. And then they added another $316,000 and they purchased the inventory for $316,000. End of the period, your accounts payable balance was $34,000. So the account payable decreased by $7,000. That means they must have paid more than the purchase. So out of this total payable, they still have $34,000 left. So how much they should have paid? So the amount, if you analyze these numbers, they should have paid $323,000, which is this plus this minus this, okay, or this plus this. So payment for inventory purchases, $323. Okay, folks, this is the number. I am bringing it here, and this is the number for the inventory purchase payment. Now we have to look into other expenses. So if you look at your income statement, they have wages expense and they also have wages payable account. So here, the second one we have to calculate is payment for wages. So if you look at your wages payable account, you can see the beginning balance was $33,000 and the ending balance was $45,000. And if you look at your wages expense from your income statement, that was $62,000. So when they incurred this $62,000 wage expense, they would have credited the wages payable by $62,000. So if you look at this number, okay, if you analyze this, how much of the wages payable they must have paid. Okay, whatever they paid out of the wages payable would have been debited. Remember that, folks? So if you look at this number, out of this, they have paid $50,000. Okay, folks, got it? So $50,000 wages payable they paid. So the payment for wages equals $50,000. Okay, so this is the number here. And finally, if you look at your income statement, you have only one expense, interest expense. So if you look at your balance sheet account, there is no interest payable. So that means the entire interest expense of $10,000 has been paid in cash. So the fourth one, payment for interest expense equals $10,000. And the last expense in your income statement is depreciation expense. This is a non-cash expense. So this has no relevance in the direct method. So if you look at all these numbers, okay folks, so here what do you have? Number one, I'm going to erase the board. You have all the numbers. So here, cash flow from operating section. First number, collection from sales, 620,000. Second, payment for inventory purchases. You have $323,000. That is a negative number because the cash is going out. Number three, payment for wages. Negative $50,000. Number four, payment for interest. Negative $10,000. So if you do the calculation, that gives you your net cash from operating section under the direct method equals 237,000. So this is the same number we also calculated from the operating section cash flow under the indirect method. So this is what you will do in your statement of cash flows. Now when it comes to the investing and the financing, there is no difference between the direct and the indirect. Okay folks? Again, if you look at your numbers from your indirect method, cash flow from investing was negative $120,000. Cash flow from financing was negative $48,000. And the statement of cash flow. Okay, so here. Statement of cash flows using the direct method for operating section. There wouldn't be any change in the format, folks, okay? So cash on January 1st of 23 was $26,000. And to this, you will add the cash flow from operating section, which is $237,000. Cash from operating section, positive $237,000. Cash from investing section, negative $120,000. Cash from financing, negative $48,000. Finally, cash balance on December 31st of 23 would be $95,000. Now, one more issue, one more topic. There could be a non-cash investing and financing activities. These non-cash investing financing activities do not impact the cash position of the company. So here, say for example, a company is buying a land by signing a note payable. Okay, so when they buy a land, which is a long-term asset, that is an investing activity. But there's no cash paid because the company is what? Company is signing a note payable. That means a long-term liability to buy the land. And long-term liability belongs to the financing section. So if there is any such activities in buying or selling a long-term asset, okay, using the long-term liability account, okay, that will be listed at the very end of the statement of cash flows. They will give non-cash investing and financing activities and they will explain those activities. Okay, folks?
Thank you for watching the video lesson illustrating the direct method of preparing the cash flow statement. We have video lessons with worked out problems on all topics of financial accounting. Please do not forget to subscribe.